So now this thing, duration of a bond, we know it from previous lectures that this thing duration is different than life. I mean, life or maturity, these are different words. Life maturity is the same thing. It is like when you say that 5 years bond, so you say that it has a maturity of 5 years. So that is life of the bond or the maturity of the bond. Duration is different thing. Duration means that the time period in which you collect your investment in terms of present value. For example, if you invest $100, if you purchase a bond for $100, and of course you are going to get $6 and $6, like the coupon rate is, if it is 6%, and then in the last year you will get something like 106 or whatever. So how much time, or how much time in terms of years does it take to collect your initial $100? So of course you will find out the present value of all these things, and it is kind of a payback thing, if you remember the discounted payback, something like this. But it tells you that how many years are required. So I would say that the maturity of this bond is 5 years, but duration might be 4.7 years. Duration would generally be less than 5, because in 5 years you will collect all of your cash flows. So you can say that within 4.7 years I will collect my initial investment, and then the remaining time period, whatever it is, that time period actually it reflects the profitability. So the duration as little, if you have a little duration, let's suppose 4.2, or let's suppose that 4. So the shorter the duration, the better it is. Shorter the duration, better it is, because shorter duration means that you can recover your investment much faster. And of course, duration, it depends on what? It depends on your discount factor, because you're finding out the present values. So discount factors, when you will increase the discount rate, the present value will go down, duration will increase. So this is discount factor. If the discount factor goes up, present value, it goes down. Present value goes down, it means that duration will increase. So duration depends on the discount factor. And also duration depends on the coupon rate, because if the coupon rate is not 6 but 7%, so you are getting more money. So if the coupon rate, I would say that coupon rate, it increases, duration decreases, because you are getting more money. So when you get more money, it means that you will be able to recover your initial cash outflow much faster. So this is called duration of the bond. Duration of the bond, I'm summing it up. It is a time period, weighted average. I will use the word weighted average time period within which you can collect back your investment. So we have seen in chapter number 3 the concept of duration. Yes, we discussed it in chapter number 3. Today I just revised. In the concept of project appraisal, to give a measure of the average amount of time over which a project delivers its value. Delivers its value means that in which the time period during which you can recover your initial investment. Duration is also known as Macaulay's duration. So the formula which we are going to use, that is called Macaulay's formula, and Macaulay duration will calculate. The same concept can be applied to a bond, where it helps to explain the risk of a bond to investors. Because if duration is increased, risk is increased. Duration becomes longer, it means that time period becomes longer. Time period is becoming longer, it means that risks are increasing. So how do we calculate the duration? The average amount of time, and here we talk about weighted average time. We will talk about the average amount of time taken to recover the cash flow from a bond is not only affected by its maturity date, 5 years, it is also affected by the size of the interest, like whether $6 or $7. Coupon, which is called coupon. Example, a 5% bond in 3 years will give cash back as quickly as a 10% 3-year bond. So if percentage is changed, but you have a bigger, coupon rates, the duration would remain same. Duration measures the weighted average number of years, over which a bond delivers its returns. Okay, so as we have seen, duration is calculated by multiplying the present value of cash inflows to the time period of that inflow, and then dividing by total present value of the cash inflow, and then dividing by the total value of the present. So what we do, see here, multiplying the present value of the cash flow with the time period in which that cash flow will incur. So you will get, like, suppose $6 in year one, then you get $6 in year two. So you multiply $6 with one, $6 with two, $6 with three, $6 with four, and not $6 actually, the present value of $6, the present value of $6 with the time period in which they will occur, and then you will divide it with the total present value of the cash inflow. Whatever is the total cash flow, you divide it with that. Now, how to do that? We will do it in 2-3 ways. We'll see how this calculation is done. So let's first see a very simple thing. This is a screenshot from your book. I will create some other example as well. First, let's see what the book says. The book shows you that a company has a 5% bond in issue with a nominal value of $100 and is redeemable at nominal value, which means that $100 bond will be redeemed at $100 in 3 years' time. So there is no premium on that bond. The required yield is 4%. Required yield is 4% means that your discount rate should be 4%. So that's 3 years bond. So year one, year two, year three, it is 5%. So you get coupon $5, and then last year $100 you get your principal plus your interest $5. And then you have discount factors at 4% in year one, in year two, in year three, and then you multiply this. Now this is your discounted present value. So this is your coupon rate 5, but the present value is 4.8, present value is 4.6, present value is 93. And then this 4.8, you multiply it with the time period. Okay, so whatever it is, 4.6 into 2, and then 93 into 3. So multiply it with the number of year. Number of year is 3. So 93 multiplied by 3 is 279. 4.6 times 2 is 9.2. 4.8 times 1 is 4.8. And then you add all of these up. These cash flows you will add 4.8 plus 4.6 plus 93.3. And you divide it with the total present value. Whatever is the total present value, these 3 years you make a total. So what we are doing, it's not very complicated, by the way. My present value total is 102.7, okay? 102.7. Now, forget about these complex tables. Logically, mathematically, it is a simple mathematics thing. So you are getting actually 4.8 in year 1, 9.2 in year 3, and 279.9 in year 3. So you add these things up and you divide them with 102.7. And what you get, so it shows you that in year 1, what percentage you are getting in year 1. So this is the total, okay? So you have here 4.8, then you have 9.2, and then you have 279. Not 279 actually, 93.3. Yeah, okay, 279. And then you make a total of these three numbers, and then you divide it with 2, you get 2.87. This is one way of doing it. This is one method of calculating this duration. I will show you another method which I like more. This method is shown in the book I've just shown you, that you calculate the present value of all of these cash flows, and then you divide it with the sum total, and you find out 2.86. So the maturity of the bond is 3 years, but duration is 2.86 years. So it means that if you purchase this bond today on these terms like 5% coupon and $100 now, it means that in 2.86 years you are getting back your investment, and the remaining 0.14 year, that would be your profit taking. So at the time period 2.86, you become break even. You already have collected your total investment. That is called Macaulay's duration. One method of calculating. I'll show you another method which is probably I like that more. Then you have, this is the formula actually. Now when you see the formula, it may be, it scares you a lot, but actually it is not. I mean, it says T times C divided by 1 plus YT, then N times M divided by 1 plus Y power N. So you will have many years. So this is T1, year 1, and then plus 2. So you would have, not only t times c divided by 1 plus y, and you would say that it is t1, okay, t1 plus, again you will have t multiplied by c divided by 1 plus y, and then t2 time is t2. And let's suppose that there are only 3 years. So and then comes the third one, which is 1 plus y, and they call it n. I'm calling it t3 because this is it is finishing. Now what is these numbers actually? What are we doing? Very simple. C is my coupon rate, so I'm getting $6. And usually what you do, how do you discount? You discount it with, you remember what, how do you discount a value? 1 plus I power n. This is how you discount it, if you remember, present value. How do you calculate present value? You say present value is equal to future value divided by 1 plus I power n. So this is y is my periodic yield, the interest rate, like 1 plus, you can call it interest rate, and power t, which is the number of year 1. So this thing we know, this is the future value and this is the discount factor. Then you will have in second year again $6, and again you need to discount it to find out the present value, right? Instead of y, I'm putting I. It's the same thing, the interest rate, the discount rate, whatever. Now what happens? 6 is understood. So C is very clear. This is my coupon rate, which is $6. What is T? T is the time period. T is the time period, like 1 here multiplied by 1. And here you would say multiplied by 2, because it is the second year. Why are we doing it? That's the question. Why do we multiply it with the time? Because we want to find out the weighted average, the proportion of amount which comes in which year. Because you might be getting $5 in year 1, $5 in year 2, and then $20 in year 3. So these are total $30. So, or maybe I can say that $20 in year 1, and then $5 in year 2, and $5 in year 3. Now, in total, you get 30. But you know that there is a time value of money concept. Here, you are getting more money in the beginning, and here you are getting more money at the end. And of course, it has lesser value. So we need to find out not only the amount, but we also want to see that this amount comes in which year. That is important. And this is the purpose of calculating Macaulay's duration, that it gives us the weighted average. Otherwise, I can find out discounted payback period. You remember? Discounted payback you can find out very easily. I mean, let me go back and explain you the situation now. I'll take some time. I'll go to Excel. I mean, I need to go back and show you how we do it. You guys see the Excel file, right? Let's suppose that you invest $100 and then you start getting, if you remember your, I'm not talking about any bond now. Okay, let's talk about bond 66 and 106. Okay, can you people see the file, Excel file?
Yes, sir.
So your discount factors, how do you calculate your discount factors? It's important. I am again switching away from the topic, but it is important so that you always remember it. You don't forget it. I don't want you to, just make some kind of memorizing things. Let's understand. These are the discount factors, okay? And we can just put them to 3 decimal places. So this is my discount factor. This is my present value. And then I start multiplying it. Okay, we forget about this first one. We don't need it actually. Let's suppose we do it this one. So this method is called discounted payback. Okay, this method is called discounted payback, which we did in ACCA F9 also. So discounted payback also tells me that in how many years you can find out, in how many years do you receive your cash, how many years you can receive your cash in terms of present value. And we know that in total we are receiving. So if I see like this, So total money you are getting probably 118, but in terms of present value you get 102. So it means that if this is the time period, if this is the total time period, so probably somewhere here, because you receive in total you will receive 102. So it means that somewhere close to here you will receive 100, which you initially invested. Okay, 100 you initially invested and 100 you would recover here. So that should be somewhere like 2.8 years or 2.9 years or something. And you can mathematically calculate it. How do you calculate it, by the way? For example, you have 1 year, that is for sure. Then you have another year, second year, it is not coming. In third year, you are getting 91, but you don't need 91 actually. You know how much do you need? I tell you. So in first 2 years, you already have recovered $11. So how much do you need from here to make it 100? See, in first year, I get $5. In second year, 5.7 plus 5.4 is 11.15. And this is a third year in which total is 91. But I don't need 91. In order to make it 100, how much do I need? I need $83, okay? So I can say that 83 divided by 91. So what is the proportion? It says 0.9. So I can say that full 1 year, I need this full, but in the third year, I only need 90% of the amount. This 91 is 100% of the amount, but in order to make it 100, I do not need 91. I just need 83. So 83 is what percentage? I just calculated the percentage. So I said 83 divided by 91. It means that from the last year cash flow, only 90%. So then when you make a total, you can say that in 2.9 years, you are collecting back your money. Okay, that's what we learned in discounted payback in our ACCA F9. This is called discounted payback, and it says that in 2.9 years you are recovering your initial $100. Fine, I understood. Now then, if I can calculate 2.9, then what is the difference in Macaulay's duration? Why do I need now Macaulay's? If I already have discounted payback, why do I need Macaulay's? Because in discounted payback, what we did, we ignored the timing of cash flow. Okay, in which year cash is coming more, in which year cash is coming less. We never multiplied the cash with the number of period. So this was a major flaw in this discounted payback. So when you have your discounted payback and you just start multiplying the present value of cash flows, which you have here, you start multiplying with the period in which the cash is coming in. So then you say that I am actually doing weighted average time. It's not just time. The word is not time, because if you want to calculate time, then 2.9 is fine. But I want to do weighted average time period. Weighted average time period means that I not only want to see what is the cash flow, but I also want to see that in which period the cash flow is coming. Now, this is what makes your Macaulay's duration different than your discounted payback period. Otherwise, you always had discounted payback. So Macaulay duration we brought in because we not only said that, because here what I was doing, I was discounting the cash flows. Okay, $6 discounted to 5.7, $6 discounted to 5.4, 106 discounted to 91. I am discounting. And in Macaulay's, I also discount. But what we do in Macaulay's, that we multiply it with this factor, which is your time factor. If you now pay attention to the formula, it is the same thing. You are actually discounting the cash flows. You know, cash flow in year 1, cash flow in year 2, cash flow in year 3, and cash flow in the last year. M is what? M is the bond's maturity value. Maturity value means $100 plus that $6. So this is what we did in discounted payback, 6 and 106. We did the same thing, and we were discounting it at 1 plus I power 1 power 2 power 3. The only difference is that you multiply this with the number of the year. Like this cash flow comes in year 1, multiplied with year 1, multiply with year 2, multiply with year 3, and this is N. N means the final value, and of course the final value means the number of the duration, the number of the periods which are in there, the last value. 4 or 5 or whatever. So this is called Macaulay's duration. The formula I have explained you, and the similarity or difference with the discounted payback, because discounted payback was also telling me that in how many years I get back my present value of investment. Macaulay also tell me the same thing, but the only difference is that Macaulay's consider the timing of the cash flow, which the payback method does not. So if I go back to the same thing example which we showed you earlier here, so what we did, we got the numbers 4.8, present value 4.6, present value 93, and we started multiplying them with the number of the year in which these cash flows are occurring. Okay, so of course if 279 had been in the beginning, it would have a different impact. So we discount them up, then we total them, all of these numbers is 279, 9.2 and 4.8. We divide it with 102 and we get 2.86. So this is 2.86. If you pay attention that what was when we did it with payback period, if you see payback period was 2.9, these are the same numbers. You were doing it with $6, $6, $6, and you were doing it with 5% in that example also on the PowerPoint. But that gave you 2.86, it gives you 2.90 because you ignored the time, the timing of the cash flow. Okay, so the formula I've explained you. For example, now let me do or show you how to do the calculation with another style of table. Like I said that they are very similar, logic is same, but slightly different. For example, a 2-year bond with $1,000 par pays a 6% coupon semi-annual, and the annual interest rate is 5%. Okay, so coupon is coming $6, 6%. 6% means 1,000 into 6%, so it is 60, 62 years. Okay, 2-year bond, 60 and 60. But coupon is paid semi-annually. It is paid semi-annually, which means every 6 months. So although it is paying 6%, but 6% is paid semi-annually, which means $30 plus $30. So you might be getting $30 on 30th of June and $30 on 31st of December. And the discount rate is 5%, and we need to calculate. So how it is done, thus the bonds market value is 1018. Okay, let me go back to Excel and we will try to do it ourselves. Okay, we'll try to do it ourselves. Do you people see the Excel file? Is Excel there?
Yes, sir.
Yes, sir. Yes, sir. Yeah.
Okay, 2-year bond coupon is 6%, and discount rate, or you may call it yield, is 5%. So it means that the 6%, you know that your discount factor will be with 5%, and 6% is given only to calculate the amounts. So you have your time periods here, and so because it is semi-annual, and by the way, I would say that coupon is paid semi-annual. You see, timing of cash flow is important. So you will get in 0.5, which means half year, 1 year, 1.5 year, and 2 years. So these are the 4 years in which you are going to get the cash. Like not 4 years, actually 2 years, but 4 terms. And how much you are going to get, by the way, you are going to get 30 here and 30 here. So it makes a total $60 in year 1. And then you will get 30 here and 1030 here. Okay, like the last 6 months interest and the principal, which is 1,000. And I forgot to write down here, I should say that, $1,000 2-year bond. So this is your, coupon, or you can call it your cash flow, whatever you may call it. And then you have to find out your discount factor. Now, discount factor will be done on 5%, okay? But remember that when you will do that with 5% and you have 5% for the year, but this cash is coming only for half of the period. So you have to use the formula like this: 1 divided by 1 plus this 5%, but you should divide it with 2. Okay, I need to put equals to sign, equal to 1 plus this 5% and divided by 2, so that it becomes 6 months interest, because 5% is for full 1 year and I'm going to compound it on 6 monthly basis. So if it is either I should say 2.5%, or I can say 5% divided by 2. And then we would say that power, okay, power. And in power, actually, you should be using 1, because this is the first payment. This is the first payment, I should say like this. So power is not 0.5, power is still 1, like first compounding. First compounding.
This year is not completed, right?
Sorry?
This year is not completed, but we will take 1.
No, we will actually, we always discussed this thing that n. What is n? N is actually not the number of year. N is always, n is the compounding period. What does that mean, compounding period? Okay, some of you people might not have done F9 with me, so I will need to explain it again. Many times we have discussed or seen this n, and we always thought that n is probably the number of years. N is not the number of years. N is actually the number of compounding period. What is compounding period? Compounding period means the period for which you calculate interest. The period for which you calculate interest and probably add it to the principal. Let's suppose that if I say you that you put money in a bank for 3 years, at say 10%, and then they say that interest is compounded semi-annually, which means twice a year. So then in this case, your number of years are 3, but your n will be 3 times 2, 6, because there will be 6 compounding periods. Like within 1 year, 2 times compounding, second year, 2 times compounding, third year, 2 times compounding. If I say that interest is compounded quarterly, so now your n will become 3 times 4, because there are 4 quarters, it will be 12. So you are increasing your n. Okay, let me do like this. Let me show you how it will work. Let's suppose that I have to, these are my terms and conditions, and how much money I have put in the bank. I have put $1,000, okay? And I'll show you what will happen. Okay, we are going a little bit away from the topic, but it's important. $1,000 invested in a bank for 3 years at 10%. This is the situation. And I say that find out the future value of investment if compounded annually, semi-annually, quarterly, and monthly. Now, what I'm saying that compounded annually, it means that find out the interest and add it on the top of the amount with the principal. Like if I do it manually, let's suppose I say that in year 1, year 2, year 3, and I'm doing annual compounding. Okay, annual compounding. If I'm doing annual compounding, I would say I put $1,000. My interest is 10%. So it means that the money which I get interest for the year 1 is 1,000, and you add it up, and it becomes 1,100. And then in year 2, you are putting 1,100, and then you would say the interest here is 110, like 10% of this amount. So when you will calculate your interest payment and your future value, so your $1,000 will become 1,331 in 3 years time. And what I'm doing annual compounding. Annual compounding means that I'm calculating the interest and I'm adding it to the principal amount one time in the year at the end of the year. So it means that throughout the year, you might have been earning something interest, but you were not getting any benefit. You see, throughout the year, for this full 1 year, you calculate interest only on 1,000 and then you multiply it with 10%. So we calculated the interest. We calculated the interest on this date. And if you see that in next year, your interest income is more. Why your interest income is more? Because your interest has started earning interest, interest over interest. Because now your investment has become 1100. Before it was 1000. So before 1000 was earning 100. And now what has happened? 1100 is earning 110. So this additional $10 of earning, it is actually coming back from this $100 interest. So in year 2, your interest has started earning interest. And that's why your income is more, because you were doing annual compounding. Now, my question is that during the first 6 months, you might have earned something. Let's suppose you might have earned $50, 1,000 into 10% into 6 months. You definitely would have earned $50 here, right? $50 until the first 6 months. But this $50 did not give you anything. You did not say that, okay, $100 from here and $50 into 10% into 6%, $2.5 I should earn also here. But it was not done. So your money, your interest which you earned throughout the year, it was like useless. It was not giving you any benefit because you calculated interest only one time at the end of the year. And your interest only started giving you benefit in the year 2. So annual compounding means that when you calculate the interest at the end of the year. Now, how do we use the formula? If I have to write down it with the formula, not with the table, I would say 1000 multiplied by 1 plus 5%, or sorry, 10%. Okay, let me write down with hand. 1 plus 10%. And we say that it is power 3. This is the formula. 1 plus 10% power 3. If I take it here, it will give me 1331, the same amount which you have here, because I'm doing annual compounding. If I have to do semi-annual compounding, I would say 1000 multiplied by 1 plus 10%, but 10% is for the full year. So I'm doing 6 months compounding divided by 2, which means that within 1 year, there are 2 compoundings. And then when you will say power n, now because you divide interest with 2, and the number of periods will become 6 this time, because within 3 years, there are 6 compounding periods, 6 months, 6 months, 6 months. And if you pay attention, your total amount, total earnings or total investment has increased. It is not 1331 anymore. It is 1340. You got more money because your interest started earning interest earlier, like 6 months. If you want to do it quarterly compounding, so in quarterly compounding we use the same formula, but we'll say that 10% is for the full year divided with 4, and then this one becomes 3 years multiplied by 4, it will become 12. So 12 compounding periods will become like this. Now if you see, your investment has become even more, it is 1344. So it is suitable for you to do quarterly compounding. And if I have to do it on monthly, I would say 10% divided by 12, and here I will put 36 compounding periods, because 3 years and monthly. So if you see that if you are doing monthly compounding within the same bank at the 10%, you, instead of getting 1331, you are getting 1348. And by the way, the banks, they charge you on daily compounding. And that's why when you make a late payment to the bank, as soon as you do not make a payment to the bank, you become late payment, you have realized that their interest costs start, straight away goes up. Because when you make a late payment, from that day, they start calculating interest over interest. They said, okay, you had to give me $1,000 today. You did not give me. On that 1,000, I would have earned this $2. So now I'm going to calculate interest on 1,000, not only 1,000, but 1,000 plus 2. And next day they will add again. So bank is going to do with you daily based compounding. And in daily compounding, this number will become very fantastic number, okay? Because I just took a power 36. You can imagine that if I go to the bank and I say that I'm going to put money for 3 years, and then I would say 10% divided by, this is full year, divided by 365. And here I would say, 365 times 3, which is something like, I don't know, maybe 1055, something like this, how much it becomes. So if I somehow, no bank would give you this deal, by the way. You see, I made some mistake. 10% divided by 365, and then 3 into.
It's 1095.
1095. So it even becomes more. So banks usually do not give you such a deal. Banks, they usually give you maximum monthly compounding, maximum monthly compounding they can give you. Anyways, so I'm sure that you understand the concept of N now, right? N is the number of compounding periods. I come back here, we say $1,000 bond, which is 2-year bond, coupon is 6%, discount rate is, or yield is 5%, and coupon is paid semi-annually. So semi-annually means that within 2 years, you will have 4 periods. And when you have 4 periods, so what we said, 1 divided plus, this 5%, and I took period 1. I did not take power this, power 1, okay? And this one we should be doing as F4, and then I just copy paste it here. So these are my discount factors, okay? And then I would say the present value. And what is the
sorry, so just one thing regarding the discount factor. So if we took the time periods, this means then we would have had to multiply it by 2.
I don't get your point.
If we took the time period as a 0.5 into power 0.5, then we would have had to multiply it by 2 because of the semi-annual thing.
Yeah, I mean 2 multiplied by 2, like 2 years, and every year there are two half years. So total number of years will be, total number of discounted compounding periods are 4. Years are 2, but within 2 years there are 4 payments.
Yes, but even if we would have taken the time periods, multiply by 2, we would have got 4.
I wouldn't call it, okay, you can call it multiplied with 2, okay, that's fine, because in 2 years, so there are 2 multiplied by 2, if it is like semi-annual. If it had been quarters, then 2 multiplied by
we would have 4.
8, then we would have 8 compound periods.
Yes.
Okay, so here we got now present value. So these are my coupon rate, these are my discount factors, and these are my present values, okay? So when I calculate here, it gives me 1018. Can you tell me what is this 1018? What can I call it, 1018? What is that?
Future value or the...
No. This is the present value of future cash flows. So whatever this bond is going to give you, this bond is going to give you 30, 30, 30, 10, 30. But the present value of these cash flows is 1018. I can say that 1018 is the present value of future cash flows from the bond, right? Is it correct? Therefore, we can say that the market price of the bond is 1018. Please remember, this is something I explained in last class also. The market value of share, the market value of the bond is always equal to the present value of the future cash flows. If you ask me that how much money are you willing to, or how much price are you willing to give to this bond. If I say if these are the terms and conditions, if these are the terms and condition, the market price of the bond would be 1018, because I would never give anything more, because this is what I'm receiving. So if I'm an investor, as an investor, this bond will give me these cash flows, but the present value of the cash flows is 1018. So this is actually the market price of the bond. No investor would ever give anything more than what they receive. Are we clear on that?
Yes, sir.
Yeah.
So then what we need to do, then we need to calculate the proportion. Anything you want to ask until here, please ask. Anything you want to ask? Okay.
No, I'm good.
I'm fine, sir.
Okay. Where did this thing go? Yeah, we are here. So these are now these are your present values of cash flows in the future periods. Now we want to find out the proportion in different period. For example, in this first period, how much cash I'm getting? I'm getting 29, and how much is total? Total is 1018. So this number, if you see the number, let's call it 0.028. What does this number mean? Can somebody tell me how do you see this number? 0.027?
The time, or is it proportionate?
That's the proportion. You can say that out of the total 1018, 2% of the money you receive here, right? Because how did I calculate? I just said 29 divided by 1018. So it is like kind of a percentage proportion. Like 2% of the money you receive in first period, then 2% you receive in the second, then third, and then the fourth. And this is the money which you are receiving in different. So you calculate the proportions, and then you find out weighted average. So this is the money proportion which I'm receiving. So I would say that this thing, multiply it with the time period. So in the first time period, which is 0.5, I get 0.287. You just need to multiply these things, and then you just copy paste the table and you find out. You get 1.91. This is your Macaulay's duration, 1.91. Are we clear on that? We just calculated the weighted average. Any question you want to ask? Any column which you do not understand?
So about the column, why do we multiply the proportion with the time period? I mean, what's the logic?
To find out the weighted average thing. To find out the weighted average thing.
So this 1.91 represent the cash flows. The time we will get this 1018.
Yes. No, not 1018. You get your $1,000 back in terms of present value.
Okay.
So in 1.91 years, you will get back your investment of $1,000.
Right.
So this, why did I show you this example? The purpose of showing this example is that in many times you will get some semi-annual thing, quarterly compounding, semi-annual coupon payment. So this is how you should be multiplying it. Any question you want?
What does this number say?
Which number? 1.91?
Yes.
1.91, I would say that, let me write down, you would recover your initial investment of 1000 USD in 1.91 years. Now the duration of the bond is 1.91, and the maturity of the bond is, say, 2 years. It's a 2 years bond, but you recover your money in 1.91. What if we increase the coupon rate? Actually, I just put these numbers 30-30 like this, and the discount rate 5%. And we said that coupon is 6%. Let's suppose that coupon is not 6%, coupon is 8%. Let's suppose that coupon is not 6, coupon is 8. If coupon is 8, then you would receive $40 here, $40 here, $40 here, and 1040 here. Now you see that your duration has gone down to 1.89. Like I said you before, that if coupon rate goes up, which means that you will start receiving more cash, your duration goes less. Very logical. If I'm getting more money, of course I can recover my investment much faster. So if I, let's suppose if I don't play with the coupons, let's suppose that I'm not playing with the coupons, I'm just playing with the discount factor. My discount factor is not 5%, my discount factor is 3%. Then again, my duration will decrease. There is a very slight difference, but there is a difference. And if my discount rate goes up, my duration will increase. So your discount rate and your coupon rate, both of them will impact the duration. Right now, what you understand from this calculation, that a 2-year bond will give back all of its investment in 1.91 years. You can recover your investment in 1.91 years. Understood?
Yes.
Okay. So this is one way of doing this calculation. Like I told you that there are 2-3 different ways of doing it. I personally prefer like this because it makes me more clear that this is my first compounding period. I get $30. The present value of $30 is 29, and this 29 is only 2% of my total amount. And when I multiply this 2% with the proportion, so actually when I weighted it against my proportion, this is 2%, and I'm getting it here. It is 0.14. Then I get this period. Then there is a second period, which is at the end of the year. Again, I receive $30, and the discounted price value of this $30 is just 28. And proportion is again 0.028, and I find out the weighted average. And then I make a total of this, I get the duration. The second, now I show you with the second method, which actually was the first which we did. When I showed you the PowerPoint slide, let me go back again to remind you so that you don't forget it. So let me see, where is that PowerPoint slide? I'll share it with you. So this was another method which we did. First, I showed you this method, that what we do, that we take the number of year, we find out the present value, then present value multiply with the number of year, and then you make a total of all of these numbers, and you take a total of that, and then you divide it with their present value. So these numbers, 4.8, 2 times 4.6 is 9.2, 3 times 279 is 93 is 279. You make a total of these numbers and then divide it with 102.8. How do we do that? We can actually use this method as well. Let me go back to our Excel file, and we take the same numbers. Okay, so which time periods do we have? We have these time periods. I'll just copy paste these numbers, and these are my present values. So I take these present values, and what the method said, that find out the present value, multiply it with not the coupon rate, the present value, multiply with the time period. So you can say that this thing multiplied by this thing. So you multiplied them. So now what happened? You make a total of these present values. It gives you 1018 like before, and you make a total of these values. It gives you 572, something like this. And then you divide this thing 1018 with this 572. Wait a minute. No, 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 no. I made a mistake here. Let me see. I'm sorry. This can't be 466. We have to multiply. So actually, we have to multiply. I'm sorry. Multiply with the time period. So multiply the time period. So you get 1915, and now you would say 1915 divided by 1018, whatever it is. Okay. So I divide these two numbers. I get again 1.915. It is the same thing. Either you do it that way or you do it this way. The formula which I showed you in the PowerPoint, it's the same thing. Like you calculate this thing and then you don't do this multiplication. I use these columns. You can avoid these columns. You can just say simply 29 into 0.5, 28 into 1, 27 into 1.5, and so on. So you multiply with the time periods, make a total, and then this total divided by this number. You get your 1.915. These are the two methods. Whichever you want to use, you can use. Both will give you the same answer. So we go back to our PPT and what we have here. Now, I'm moving up to, so Macaulay's thing is done. Then we say sources of finance, 1, initial coin offering.